What is the lowest credit score I need to have in order to qualify for a VA loan?
It depends on who you talk to, right? If you give Veterans United a call, they say minimum 620 credit score. Okay. The thing is, every lender is allowed to have their own overlays.
Mm.
Is there a minimum VA credit score? No, there's not.
There's not. Welcome to episode 17 of the Real Estate Junkie podcast. This week, I've been busy hosting a family reunion, so I pushed out our original guest to next week. Today, we'll be revisiting a conversation we had with Mark Kong, a VA loan expert from episode 4. In that episode, we covered many topics, but his insights on VA loans were so valuable that I've clipped out that segment for this episode. Mark graduated from West Point, served as an Army officer, became an active duty house flipper, got his real estate license, sold homes, and eventually became a loan officer, starting his own company, Evolution Mortgage. Whether you're an active duty service member or a veteran, this episode is packed with essential information to help you navigate the VA loan process. So let's dive into the conversation and learn from Mark all about VA loans. And at this point, did you already own? You owned a house, right? You bought one house.
I own two houses at this point.
You own two houses at this point. Okay. And you had just one as a rental?
Yes. My departing residence, I turned into a rental when I moved into the second house.
The
Yeah,
first house, was that VA loan?
they were both VA. And that's the beautiful thing is like, you know, one misconception is you once you buy with VA, you can't buy VA again in the same city. Well, I had a deployment in there, and that's kind of a great reason to purchase again, right? When I deployed, that became a rental, and then I bought again.
Did you
And
have
so,
to refinance?
no,
So you had enough.
remaining eligibility.
You did. Wow.
Yeah.
Okay.
Yeah, they were
Nice.
both they were both, not luxury homes. So, yeah, if I had bought in one fourplex, in Colorado Springs, I probably would have been tapped out on eligibility. Eligibility is always limited by the county loan limit of the county you're moving to. So you could be tapped out on eligibility because you bought in Colorado Springs and the county loan limit is $726,000. However, if you move to San Francisco County and the county loan limit there's a million, now you've just opened up a little bit more eligibility.
So now you have 300K, basically.
Correct. Essentially of purchasing power. Yeah. So the other thing with eligibility is it's actually limitless until you use some of it. So if you have full eligibility, you could, if you qualify, buy a two, three, $4 million VA home, let's say in Colorado Springs, and the VA will insure all of it. And the funny thing is, like, the interest rates keep getting better, right? The county loan limit in Colorado Springs is $726,000. When you go conventional and you go above that county loan limit, you buy conventional, at 800K, that rate gets super unfavorable. That rate for conventional, under 726K, like that might be 7.5% right now. And when you go jumbo above that county loan limit, that turns into an 8.5 or 8.5 with points. Like it gets very unfavorable. And these, are just hypothetical terms, right? But I just trying to show the difference in deteriorating pricing when you go jumbo with conventional. Well, with VA, when you go jumbo above that kind of loan limit, your rate just keeps on getting slightly incrementally better, at least with us. So the rate I'm able to give someone for a $3 million VA loan is actually slightly better than rate for a 700K VA loan. So I
Wow.
tell people it's very important, especially people that are doing very, very well as veterans, maybe, they're dual income, whatever it may be, and they want to buy $1 million home. My suggestion is make sure you go ahead and restore your V eligibility, get your V eligibility back so that you could buy your dream home with a VA loan. Because for multiple reasons, it is the best product. Also, there's no debt to income per se limit on the VA loan. We are closing VA loans that are 75% debt to income. It goes off of residual income calculation, which is just completely different than a debt to income. So residual income calculation, we just have to prove that, let's say a necessary residual income is $2,000. Well, if someone's take home pay is $10,000 and all their debt is $8,000, then they have $2,000 of residual income, and the VA will say, okay, that's good to go. And that may be 60% debt to income or 70% debt to income. The other thing about VA loan is when it comes to threeplexes and fourplexes, conventional loans have the stricter debt to income limits. And for threeplexes and fourplexes, the FHA self-sufficiency test never came up in COVID because it was 2.5% rates. But now that rates are in the 6s, 7s, 8s, most threeplexes and fourplexes are not passing what's called the FHA self-sufficiency test. And the gurus don't talk about this when they make the TikTok reels. And so everyone's like, oh, just buy a threeplex or fourplex with FHA. Well, most of them don't pass the self-sufficiency test. So if you have eligibility as a veteran and you're looking to buy a threeplex or fourplex, there's a huge pool of buyers that just don't exist anymore. And the other thing is for realtors, if you have a veteran buyer who's interested in a threeplex or fourplex, that's like a very hot lead because you're really only competing against investors. Your other like first time home buyers who are looking at house hack and stuff, your conventional, most of them don't qualify and it's very, very hard to do. Now, Fannie and Freddie just dropped their requirement. It used to be 15% down for threeplex, fourplex. They just dropped it to 5%, but still with the debt to income limits and PMI, it's very hard to qualify. And so
it's because the PMI is also going to jack up your payment, and then
right.
the DTI is going to be even harder to get through.
Correct. So just because they dropped it from 15 to 5% doesn't necessarily open up a huge pool of buyers.
Yeah.
And so you do need to have reserves. So if you have a young, lieutenant who has no reserves and wants to buy a threeplex or fourplex, can't do it. You need 6 months of reserves. However,
wait, is that just for conventional or is that for VA too?
That's for VA.
Okay.
Yeah, for conventional, the reserves are a little bit different. But if you have a veteran buyer who has reserves and is interested in a threeplex or fourplex, like that's a really eligible buyer, more so than an FHA and conventional buyer. So and obviously there's a lot of veteran buyers in the Springs. But it's really interesting because right now they're only competing against, in my mind, they're really only competing against other investors.
Yeah. So my daughter joined the Air Force 3 years ago, got married. So they're a dual military household.
Awesome.
They just got done buying their second home. So they bought the first one using her VA. Then they bought another one using her husband's VA. And now they're living in that one now, so they're renting out the first one, and now they're already okay. Well, let's get ready for 3 because they're literally leveraging the VA to kind of get their start in real estate. If they both have eligibility left in the county that they live in, can they combine that eligibility together to go buy a third one? Once they hit that 1 year, required.
Yeah, regardless of whether they hit that 1 year or not, if they have a circumstance that is a good enough argument to buy again, they don't necessarily even have to hit that 1 year, right? Let's say they got a short notice PCS orders to a new duty station 6 months later because of a career move or whatnot, right? Like there could be a million reasons. Also, let's say, they had twins, right? And they want a bigger house. Right, that is an eligible reason to buy maybe even 3, 4, 5 months later than your initial purchase. So, when you close a VA loan, generally it's I intend to occupy this property for at least 1 year, right? But there's myriad of reasons why that could change. The important thing to make sure it's not mortgage fraud is to make sure that intent was there at the time you signed.
Got it.
What
Got it.
happens after that is, life happens. Life's crazy, right? You don't want to build a pattern of trying to skirt around the rules, I don't think. But again, deployments, having more kids, bad traffic, wanting your commute to shorten, there's lots of reasons that are valid. Okay, so within VA loans, in a scenario like this, there's joint entitlement. And joint entitlement could be a veteran and non-veteran can purchase a house together using the VA loan. And essentially, we have to come up with a down payment to cover eligibility gap if it's veteran and non-veteran. And then if it's veteran and veteran, that's considered split entitlement. And we can use your daughter's remaining entitlement and your son-in-law's remaining entitlement to do a split entitlement VA loan. And the way to structure that, it just all depends on the numbers. But let's say house number 1 was 300,000, house number 2 was 300,000, and they're moving to a county where the county loan limit is 726,000. So they each have essentially remaining purchasing power entitlement, let's say, of around $426,000. So they could buy a house at 800,000 and put $0 down by using both veterans' remaining entitlements. They could go over that and they would need to come up with a 20% down payment of whatever the gap
Of
is.
whatever is over that amount, right? So it's not 20% of the 800 or whatever the price of the home is. It's
Correct.
whatever that's not covered under their current entitlement.
Correct. So if they together, had, you're exactly correct, an entitlement remaining of 500,000 and they were buying a house at 600,000, that gap of 100K is what they'd have to cover. So they'd have to cover 25% of that 100K gap, $25,000. I'm a visual person, so if someone's listening to this and not following, I apologize. I like to whiteboard things, but hopefully that's not too complicated.
Yeah, this is really good stuff. So let me ask you this, and I know this. I've used my VA loan, I want to say like 5 or 6 times, but I regret it. And the reason why I say I regret it is because every time I reused that VA loan, I sold the house that I used to have on it, and I walked away from what is now probably triple the price that I bought it for. So I always regret when I sell. Like I'm a believer in you make money when you buy real estate, not when you sell it. That's just how I do it because I'm into rental properties. But I wanted to talk to you about that because I know I can refinance out. So let's say the house that I'm in right now, which it is, I purchased it with a VA loan. If I was to refinance my house right now, so free up my VA loan, I can then use it to go buy another property, correct?
Not necessarily. And that's one of the biggest misconceptions with VA loan among your kind of veteran players who've been around the block. It encompasses restoration of the VA loan. And this is what so many people and loan officers really jack up. So, and just to challenge your point a little bit is, I wonder every time you sold, because it was primary residence, right? In most of those instances, you probably didn't have to pay any capital gains tax on that appreciation. And so I wonder, right? Because if someone owns a property 2 years, you could sell and essentially not pay any capital gains up to $250 or $500 if married. And so I guess my only challenge to that would be, with that cash, I'm sure you went and bought more rentals, continue to build your portfolio. So I wonder what the opportunity.
No, actually I didn't, because that was before I had any sense on how real estate worked. So no, that was just like, moving from one place to another over the years.
Gotcha.
And not realizing that, man, I should be just holding on to these properties versus selling them. I actually did refinance a VA loan one time, like out of the VA to free it up to buy this house that I'm in right now. But that's the only time that I actually did that. And I got my eligibility back so I could buy the house that I'm in now. But that was the only time that I actually refinanced to get it back. The rest of the times I lived in a house for a couple years, small 2-bedroom, needed more space, sold it, bought a 3-bedroom. And yeah, when I made those moves, I was just walking away with that cash and not investing it in real estate like I should have been.
Yep. So depending on how your restoration was done, if you refinance right now to conventional, you may not be able to go use your VA again.
Really?
Correct. Yeah, and I could look it up for you right now. Actually, if you want, we could cut it out for a sec, or cut the show for a second.
Well, we could do that afterwards. That's interesting.
Sure.
Why? Like, explain that a little.
Yeah. So there's a stark difference between basic restoration and one-time restoration. And one-time restoration is once in the veteran's lifetime, and it's a golden ticket. Okay. So to back up, let's talk about my scenario. When I left Colorado Springs, I ended up selling both properties that used VA entitlement. When the veteran sells or disposes of a property, they could then do a basic restoration and get that entitlement back with no asterisks.
Yeah,
now,
that's what I did. I'm pretty positive that's what I did.
Well, that's what you did for most of them.
Yes.
So most of them should have been a basic restoration.
Yes.
If those two properties I kept and I refinanced to conventional, but the veteran me, I retained those properties. So on title, it's still Mark Kong. Once those are both refied to conventional, I cannot do a basic restoration if I still own them. I can do a one-time restoration, and I could pull that trigger only one time. And so if I did a one-time restoration, I would get all my restoration back, right? And then I could go buy a third property using my VA entitlement. Let's say that third property is for $800K and it taps out all the rest of my VA entitlement. Well, now that I've used that, even if I now refi that to conventional 5 years later, I cannot get my eligibility back because I've used my one-time restoration. As long as I retain that third property is the one that my entitlement's tied to. So if I retain that property, I'm never getting my eligibility back. Whether it's conventional, etc. Even if it's paid off in cash, if I retain that property, my entitlement's used. If I sell that third property, I can now do a basic restoration again. So there's always a way to use your VA loan again, depending on what you're willing to dispose of. But it's the one-time restoration. A lot of people don't distinguish it. And there's a misconception among, especially a lot of military specializing realtors, that's just like buy at every duty station, keep buying at every duty station. That's not feasible. And a lot of people think, well, if you just refi to conventional, you could keep buying at every duty station.
You can only do it once. You can only do it once is what you're telling me.
You could maybe do it 5-6 times. It depends on the loan amount of the houses, right? Because I could buy 4 really cheap houses and then pull my one-time restoration and then buy 3 more cheap houses. So it all depends on the loan amounts versus the county loan limits. So it can go more than one time, but that one-time restoration, that card could only be pulled once.
Okay, so let me just for the listeners that are out there, see if I get this right. So let's say my entitlement was $500,000, okay? And I bought a house for $500,000, so it's completely used up. If I was to sell that house and basically pay off that loan, I would get my full entitlement back to go buy another home, correct?
With no asterisks. Yep.
With no asterisks.
And that's a basic restoration.
And that's a basic restoration. And I can do that as many times as I want. So in a 10-year period, I could buy 10 homes. As long as I'm selling and paying off that loan, every single time I get my full restoration back, right?
Correct.
Okay. However, if I don't sell that home and I just refinance out, I can restore that entitlement and I can go buy another one. But after that, if I tried to refinance that second home, I wouldn't be able to buy a third home. Is that correct?
Correct. And I've seen loan officers mess this up. I've had a buddy of mine, I told him, hey, he had a fourplex in Colorado Springs, bought VA. It appreciates. He refinances to conventional. A couple years later, he buys, house and cottage VA that maxes his entitlement. I know I did his one-time restoration because he retained that first house. And another lender was telling him, oh yeah, just we'll refi you to conventional investment and go buy with your VA again. And then this loan officer was like, I get a refinance and I get another purchase. It's two deals.
Yeah.
And I told him, no, it's not going to work. And this loan officer, had 20 years experience, probably closed hundreds of VA loans, and still didn't fully understand how restoration entitlement works. Ended up where I just really encouraged my friend. I was like, go above this loan officer because they can close the first refinance for you, right?
Yeah,
That's not going to get stopped. The only thing that's going to get stopped is when they apply to the VA for your new certificate of eligibility. It's going to come back as a fat no.
Yeah.
So this loan officer was just kind of, blowing smoke, and maybe he just didn't know the rules around it. And so I just encouraged my friend, hey, skip the chain, go talk to his boss, talk to his boss's boss, because this is your loan that you're going to refinance from a low rate to a super crappy rate on the promise that you'll have your eligibility back. So you got to, and so he did. And they're like, yeah, no, that's not going to work. And so
Wow.
there's loan officers out there that are considered VA experts, that all their realtors think they're VA experts, that shouldn't be even licensed.
Wow. One thing I did want to ask you is because you sectioned out triplexes and fourplexes, you didn't mention duplex. Is there a different requirement on the duplex as far as the VA loan is concerned?
For the VA loan, no. The reason why I sectioned that out is for competition reasons. So my point with threeplex and fourplex is VA buyers have a distinct competitive advantage for threeplex and fourplex because of actually an FHA requirement. The FHA self-sufficiency test only applies to three and fourplexes, not to duplexes. So my point being is if veteran is bidding on a duplex, they may be competing with a lot more FHA first-time buyers versus for threeplex and fourplex, in my mind, most of their competition is only other investors.
It's not going to be a FHA loan because the self-sufficient, especially with today's rates, self-sufficiency is going to be hard.
It could, but probably not. Yeah.
Got it. Got it.
This year, I've had one deal that's passed an FHA self-sufficiency test, and it didn't pass off the bat. What we had to do is get the seller to buy down the rate with $10K of buy down. Okay. We had to shop the insurance to multiple insurance companies to get the insurance quote down with a super high deductible. Okay. And all this time we're just trying to lower the PITI so it passes self-sufficiency, right? And so we're lowering the PITI by buying the rate down. And I'm talking, we bought the rate down to the lowest rate on the rate sheet. We couldn't go any further. There's no lenders that even offered a fatter buy down for a better rate. And then on the other hand, we had to fight with the appraiser to get to change, and we're just praying because the appraiser could have told us to kick rocks. And it wasn't me, it was the borrower. I can't do this with the appraiser, but the borrower's, trying to get the appraiser to change the rental amounts because it goes off the rental amounts on the appraisal from, let's say $800 to $900, right? So on this side, we're trying to lower the PITI. On this side, the borrowers, and he was successful. And the appraiser's like, you know what, kind of listen to the argument, listen to some rental comps. And he redid the report, which is very rare, to a higher, higher rental amounts. And so that only passed kind of by luck of the draw, if you will, or an appraiser who's willing to redo their report. And that's what we had to do to even barely pass self-sufficiency. And that was one of many this year. And a lot of people just think, oh, FHA, threeplex, fourplex, boom, let's go. And it's not that simple. And it's really, in my mind, VA buyers don't know the luxury they have when it comes to purchasing and controlling a big portion of real estate.
True. And you know what? I really hate the FHA loan, honestly, because of not just the self-sufficiency test part, but that PMI that will never go away until you refinance out of that FHA loan. At least with a conventional loan, you can once you know the home is appreciated, you can contact the bank and you can get the PMI removed. You cannot do that with an FHA loan. It's stuck there forever until you refinance it, and I think that's horrible. That's a big chunk of your payment every month.
Well, FHA definitely is not for like your more savvy people. So the other thing about that monthly mortgage insurance with FHA is it's the same regardless of credit score. So if someone's to buy a duplex or fourplex 5% down conventional,
They're going to pay PMI still, but it's not going to be there forever.
but more importantly than that, that PMI correlates to their credit score.
Got it. Okay.
So if they have a 750 credit score, their PMI for conventional is going to be much better than if they had a 580 credit score. But for
Got it.
FHA, that monthly mortgage insurance is the same regardless of whether you have an 800 credit score or a 600 credit score. So again, it's not to dog on the FHA, and for honestly, for low credit individuals just trying to buy a primary, FHA definitely serves a purpose. But when the gurus talk about FHA for investment purposes, it's definitely more limited than people will
Well,
advertise.
definitely being a veteran and having the VA loan is definitely you're one step ahead of everyone else. Um, so let's talk a little bit more about the VA loan as far as you mentioned credit score. What is the lowest credit score I need to have in order to qualify for a VA loan?
It depends on who you talk to, right? If you give Veterans United a call, they say minimum 620 credit score. Okay. The thing is, every lender is allowed to have their own overlays.
Mm.
Is there a minimum VA credit score? No, there's not.
There's not.
As a broker, I have access to lenders that will go down to a 500 for a VA. Okay.
And I assume
So,
you're paying a price for that, though, right?
well, each lender is going to have their own credit buckets and rates that correlate to those credit buckets. So, yes, someone with a 505 credit score is not going to get the same rate as a veteran with a 680 credit score, but it is feasible. Okay. Now, some lender could say they could do a 480 credit score VA loan. Okay. Um, Also, another good question is like, what's the max VA loan amount? Well, there is none. The VA doesn't dictate a max loan amount. If there's a lender that'll fund a $35 million VA purchase, according to the VA handbook, it would be VA insured. Now, each lender again has their overlays, and I actually want to dive into overlays a little bit here, but most lenders, their VA max loan amount's about 3.5 million. So if someone asks me, what's your max VA loan amount? I usually, instead of giving them a long answer, which I'm happy to do, I usually just say, hey, for most of my wholesale partners that I work with, and I work as a broker because that's where I believe I get the best rates. But for max VA loan amount, I usually say 3.5 million. But if I needed to find a lender that would do a 5 million VA loan, I could probably do so, right? So speaking of overlays, every lender is allowed to have their own overlays. And the reason why I think this is important is because some lender might deny you for VA loan at a 60% debt to income, but another lender might be okay with a 70% debt to income for VA, as long as it passes residual income. The other thing is these overlays, lenders can also apply them to their assumptions. So I may qualify a veteran for a 70% DTI loan. However, all these lenders have very low incentives to process these assumptions. And assumptions are something that's super hot right now. You've done them for your clients. But a lender may be approving loans out the gate, new loans, regardless of DTI, but they may put a 41% DTI overlay on their assumptions because as just a way to block them, because they're making no money on assumptions, so might as well just deny as many as possible, right? So and realtors don't know this, and realtors will just say, oh, the lender denied the assumption, they broke the law. And it's like, well, what lenders can't do is they can't just not receive a 1003 mortgage application for assumption. They're required to process assumption paperwork. They could be slow, right? There's federal laws on the timeline in which they need to receive that application and either issue a conditional approval or a denial letter. But they could just put overlays on it that are super unfavorable to pretty much deny the majority of assumptions, or as many as they can. And we also talk secondary financing. A lot of lenders and people are like, "Oh, I know a lender that'll cover the gap and do a second loan for the gap." Well, the VA handbook says that second lien has to be assumable. So, is this second lender making a small second loan assumable? First of all, probably not. And if they are, can that first lender just deny it for an overlay saying that they don't allow secondary financing? Yes, they can. Right. So what I dislike is a lot of the messaging around, oh, this loan's assumable, this loan's assumable. Has that agent even contacted, or has the borrower even contacted the current servicer to see what the requirements and overlays are for that assumption? As a listing agent, I think if you're going to advertise assumability, one, clarify what that gap is between the purchase price and the sale amount. First of all, that's almost never done, but please do that, right? Second of all, have your seller contact the servicer and figure out the process step by step for assumption, right? Oftentimes it starts with like a limited power of attorney so that new borrower could even contact the servicer. And then also what their requirements and their overlays are for that assumption process. Because their overlay, again, might be 41% DTI, whereas no one really has that overlay for VA purchases.
Got it. Wow, that's, this last VA assumption I worked with a client on, he bought basically a triplex. Mm-hmm. It literally took over 100 days. It was, and that was emailing and calling the lender like every single day. He was calling, the seller was calling, I was calling, we were all calling, and it was just, it was in the end awesome opportunity because he got a 2.75% interest rate, but it just took forever. So definitely worth it, but I didn't realize that they could have these overlays in place that completely just shut the whole thing down. So you're thinking, hey, we're in contract for this house and we're going to assume the loan. The lender can legally put the brakes on and no, you're not assuming this loan because of their overlay. And they have the power to do that, and the VA can't get in between that in any way?
The VA can't force a lender to lend on a deal.
Got it. Wow. Okay.
Yeah, lenders are allowed to have their own. There could be a VA lender out there that puts their VA overlay at a 720 credit score. They don't want to lend anything in that credit bucket under 720. That's completely allowable. So there's certain rules that they do have to follow. There's certain rules they don't have to follow. I think the important thing to note here is most lenders and servicers don't have an incentive, financial incentive, then don't get paid to process assumptions. So if you're the owner of one of these companies, how much manpower are you going to dedicate to a department to process these assumptions? Okay, and even being able to call and email the lender is actually a step above some lenders.
Oh, I know.
My brother-in-law did a VA assumption, and everything was via snail mail. He had to snail mail in a 1003 mortgage application, and that took closer to 6 months to close.
We had the same thing, but luckily, a month into it, they transferred the loan to another lender, and that lender was much easier to work with. But the first lender we were working with, I kid you not, like the emails we were getting back had to be like ChatGPT or something because they were just like completely automated. Every time we'd reach out, it was like we had to start the whole thing over, conversation again. We were even referencing the case number and everything, and it was like they responded back with the same generic thing. And it was ridiculous. They definitely didn't make it easy. And then, thank God, though, they transferred the loan, and the new lender was easy to work with, and we got it done.
Yeah. Great work, by the way. That's hard to do. Even finding that deal for your client. I know we've talked a little bit about offline, but great work. That's very hard to do. And not many agents, whether in the Springs or otherwise, would go through that amount of work to secure a deal for their client. So
Yeah, I mean, it's definitely an opportunity if you can get it, because I mean, 2.75, 3% interest rate. Like, if you could figure out a way to grab one of those properties up and not have to, what is today's rate right now? It's like what?
It's always really tough to quote rate because there's a lot of lenders out there that'll say, "Hey, my rate's 6.5," but they're baking in a point, or they're
Yeah,
baking in a point and a half.
yeah,
So we, for us, our goal is to always be kind of half a point to a quarter point better than most lenders out there with the same fees, right? So if they're charging 1 point, our goal is that if we charge you at the point, we're better in rate by a quarter, 0.5%. So
nice.
we've structured our company with very low overhead, very low marketing budget. And there's a lot of people out there that, would rather work with a lender, that's not us. But our goal is there are good agents out there that would rather work with a lender that has really competitive rates than work with a lender that maybe has a higher marketing budget to pass along to them, because ultimately, typically the clients kind of paying that bill at the end of the day, in my opinion. That's how we structure, and we kind of said, hey, the people that want to use us are the type of people we want to work with.
Evolution Mortgage. What made you guys come up with that name?
Want to be better every day, and it sounds cliche, but the industry is going to change. The company shouldn't stay the same, right? So like
Yeah.
right now, we're a team of 7, right? That's going to grow over time. And, as things change, right now, the back end wholesale lenders that we have, maybe there's new players that come up on the map in the next 2, 3, 4, 5 years. So the industry is always changing. It should be changing. We should be changing at a company to get better all the time. There's decisions we made from the get-go of like, we want to be better, right? So every decision we make is based on getting better, to keep that competitive edge for ourselves and for our clients. We just want to continue that, moving forward.
Awesome. Well, I definitely commend you guys for that. That's awesome. Veterans helping veterans. There's nothing better than that. You actually gave me a lot of insight on the VA loan stuff I didn't even know. So that's pretty awesome. And I do appreciate that. I will definitely call you whenever I need someone, or whenever I need some help. I know you'll always be there. You always have been there. So I really do appreciate that. Thank you.
Thank you, Keith. Yeah, I appreciate you. Thanks for having me on.
Awesome. All right, Mark. Well, we'll talk to you soon.
Okay, take care.
All right. Bye-bye.